Nice to see everybody again. Thanks for coming along to listen to our interim results presentation. So another great set of results for Keywords. Very pleased with the performance for the first half. As you can see, revenues are up 72%, and we grew our profit before tax by 67% to 16 million euros. Also important to know in terms of our ability to leverage our client relationships across the 7 service lines that we now have, we grew our number of clients that buy 3 or more services from us by almost 20% to now 100 clients. So good evidence of cross-selling. And something for those of you, I'm sure, that don't follow games, even you won't have escaped the fact that we have this game in the market called Fortnite, which is sucking in players all over the world. I think it now has 125 million active players. And I certainly have friends who complain about the amount of time that their kids are playing Fortnite. So what that game has done is that it has, for some of our competitors, it has sucked players away from their games to Fortnite. But on the other hand, it's also probably expanded the market for games as well. So it's quite a difficult effect to assess. But for us, certainly in the first half, it's been a little bit of a headwind. We do work directly on the Fortnite game, I think the effect of Fortnite is positive for us in the second half, but was certainly probably negative for us in the first half. We haven't been asleep in the first half. We've continued to work very, very hard. We've made 8 acquisitions so far this year. I think it was about 6 in the first half. While we're doing that, we're continuing to deepen the expertise that we have in some service lines and expand our geographical reach with those acquisitions. We've also been investing heavily in the underlying business to support the demand that we see from our clients. So we have invested in 10 of our 50 facilities, which entails expanding the amount of space that we're able to offer to clients for conducting their projects. So basically expanding headcount capabilities. And that has led to the addition of another 660 seats, which equates to a bit more than 600 odd people, because for some of those seats we're able to work shifts, so 2 or 3 shifts in some locations. We've also launched Keywords Ventures during the year, and what that is about is that over the years we've been approached by some pretty interesting businesses that have been at an early stage looking for funding and also looking for access to the games industry. And what we've recognized is that Keywords is in a position to provide fantastic access to the games industry on an international basis. And we can also invest relatively modest amounts of money in early stage technology, typically technology businesses. And not only hopefully benefit from an increase in value in those underlying investments, but perhaps more importantly, benefit from the ability to commercialize the products or services in the industry. Also, just to indicate how busy we've been pretty successful with our integration of these acquisitions, both those made in the year and those made in previous years. And I think we're particularly pleased with the integration of VMC, and perhaps later on we'll get into the effect that we've had on the margins of that business, because as you'll see in our net operating margin, we have achieved close to a 15% operating margin, and that implies that we must have improved the margin of VMC quite considerably, because when we announced that deal, we announced that it had a 9% operating margin. In terms of continuing to make Keywords the go-to provider for video game services. We've extended the range of services we offer throughout the year. So we're now in music composition and licensing. We're in marketing services, where we produce video game trailers, which are the primary asset used for marketing video games. We have a base in Hollywood, where we're able to access Hollywood actors, writers, etc., on behalf of our video game clients. We also, through the acquisition of Yokozuna Data, have entered the whole field of machine learning and artificial intelligence predictive analytics for the optimization of games and the gameplay experience for players in live operation of video games. And through our Keywords Ventures business, we've invested in a company that provides automated testing for GDPR compliance for all apps, but obviously our interest is primarily in the video game apps, which, as it happens, makes up most of the app stores anyway. So if we move on to have a look at what's going on in the market, the video game market continues to grow apace. Some of you will be aware that there's been a little bit of a slowdown in China recently because of some regulatory issues regarding the licensing of new games into China. We hope that that will be resolved fairly soon, but up until that point, the games market is growing at about 9% per annum. I don't know what the effect of the slowdown in China will be and how long it will last. But definitely the underlying trends remain the same. So, we look very much at the content side of the video games industry. And what we see there is this continuing trend towards increasing complexity of the types of games that are out there, the size of games, the type of monetization that's deployed. And we think that one way our clients can cope with that complexity is to use outsourced providers like us for some of those services. We also think that the nature of outsourcing is beginning to change. We think that people are starting to adopt outsourcing at an earlier stage in their plans for new and upcoming games, rather than sort of using outsourcing as a kind of an afterthought when they get behind with production or something. They're now building it in from the start, and they're having companies like us engage with them in a more integrated manner than ever before. And I think all of that is signs of a sort of maturing video games industry. And we're probably heading towards a model which is a bit more like the film and television industry, where 95% of production is outsourced. So overall for us, we're operating in a large market. We think it's worth about $6 billion. That's the market for the services that we currently offer. And about 50% of that is outsourced today. So plenty of opportunity ahead within the games industry. Just to give you a sense of the progress as well that we've been making, here you can see a chart of services that are provided to games companies throughout the various stages of the life cycle of a video game. The text in green are the services that we've added so far this year. Those in blue we already had and have been building up over the last few years. And the bit in red still remains out there for us to explore if we choose to do so. However, having said that, just because something's in green or blue doesn't mean that we're currently famous for providing it or that we do it at scale. So there's plenty of opportunity to grow within each of those service types. The business as we have it today, it's more balanced than ever before. Those of you who follow the Keywords story will know that we like things to be balanced, so we like a balanced portfolio of services, and that balance is continuing to be demonstrated in the chart we've got here. So our engineering business, if we wind forward a year or so, that will be a larger percentage than it's showing here because this is measured at the half year, but since then we bought Studio Gobo and Electric Square in particular, and I think Snowed In came in after the half year as well. A nicely balanced business, and as we're demonstrating with some of the logos around the side, you can see that we work on some of the world's, or I would say many or most of the world's leading video games. So a nicely positioned business. What we're not able to do, because we work on something like 500 odd games a year, is we're not able to represent them all here, but very often you'll see that we're providing multiple services to an individual game title. Our geographic spread. This is not a primary driver for us anymore. It was a driver of ours in the early days of Keywords development, so that we could match the footprint of our video game clients and service them in all the geographies that were of importance to them. But it's also important for us to be in locations where we can access good talent. So we have very few blank spots on our map, I would say. Perhaps one or two that we could consider that we're underrepresented in would be Korea, and possibly a bit more presence in Eastern Europe would not be a bad thing either. But otherwise, we're very pleased with our overall geographic footprint, and we're able to consolidate some activities into existing studios rather than just multiply the number of studios each time we make an investment. Our list of clients, we've made a habit of listing the top game companies that we work with, and we measure that against some industry studies. So the Newzoo study of the top 25 game companies, and also in this case the App Annie top 52 publishers of mobile games. So there are a couple of game companies missing from here. One of them is Apple. Apple don't make games as far as I'm aware, but they do get a lot of revenue from games, so through their platform. So that's not listed here as a client of Keywords. The other one, which falls into a similar category, is Line from Japan, that has a mobile platform. So they're not a client of ours. And then the other one that's missing is 37 Interactive, which is a Chinese game company that we don't currently work with. I thought I'd tell you that before I got asked the question, because I'm always asked those questions. Again, talking about the balance of the business, in addition to the number of clients that are buying multiple services from us, we also continue to show limited customer concentration, and I think as we stand here at the moment, no client of ours represents more than 7% of our revenues. In fact, I think nobody has more than 6.5% of our revenues. And our top 5 clients represent 25% of the business. So again, it's a nicely balanced business from that perspective as well. Our margins remain healthy, around about the 15% PBT level. And of course, our revenue continues to grow apace. I'm going to hand over to David now to take you through the details of the profit and loss balance sheet. Right or left?
Obviously, the highlights, as were flagged up in the release this morning, again, we're seeing the strong revenue growth, up 72%. Obviously, the acquisition of VMC at the back end of last year is a big driver in that. The reported revenues at 110 million, constant FX basis, that's marginally higher at 117.5. Obviously, we flagged with the trading update, and again in the release, the proportion of USD revenues is a big driver in that. And obviously year on year, H1, there's been a big move relative to the euro. Adjusted PBT, again, up strongly year on year. Net margin at about 14.5% versus 15% at the same time. Again, something that we flagged up around VMC being somewhat slightly dilutive to the net margin. Again, should be no kind of surprises there. The dividend per share, again, in line with our progressive dividend policy, up 10%, up to 0.53 pence. Net cash, just marginally after the 10.6 million in acquisitions. Again, what you're seeing similar as you see here at the same time last year, we were just north of 1 million. This is our traditional kind of low end in terms of cash. Second half of the year, we start to harvest the MMTCs, and you see a much stronger finish to the year in cash generation overall. And again, that's a trend we expect to see. We flagged up equally the new credit facility, the tri-bank party with Barclays, HSBC and Lloyds. That gives us an RCF up to 5 years and with a total firepower of about 105 million. Again, income statement, just to break obviously the headline numbers into their kind of constituent parts. We talked about the revenue being up strongly, the constant currency basis up at 117.5. Gross margin has been pleasing. Obviously, it's up on the same time last year and it's up on the full year. Again, that's probably a product of the kind of product mix that we have now. Art and engineering now representing about a quarter of our overall revenues in the period. Overheads, I suppose, disappointingly somewhat up from the kind of 20% that we've targeted. Probably a better way to look at that is that obviously with the acquisition of VMC, depreciation has kicked up quite significantly. So if you look at the overhead costs, ex depreciation on the full year, they sat at about 19% of revenues. Likewise at about the half year, for us they're about 20%. So depreciation is up significantly already. We have about 2.5 million at the half year. That's equivalent to what we carried at the full year. So that's probably distorting that somewhat. Equally, the first half of the year has been a significant part for us where we've invested back into the business. We've made all the senior management announcements, bring more senior people in, building out the base. So H1 has been quite intensive for us in terms of investing back into the business, both in terms of people and CapEx. The profit before tax, again, increased quite significantly. That's before a lot of the costs here. Again, nothing particularly unusual in terms of what we strip out to get to the KWS defined profit. Again, I suppose relative to the half year, reasonably big step up in terms of the intangible assets and the amortization thereof. But again, you were seeing that at the back end of the year. VMC again being a principal driver in that. Cost of acquisition and integration, what's basically in there is the acquisitions we've done to date. There's an element of some of the VMC related costs and also costs relating to the new bank facility that were put in place in the period. Effective tax rate, again, quite pleasing to see that continue to come down. We've made good progress in that in terms of getting it down to about 19.3%. That's a rate which I would say we will probably get or map to for the remainder of the year. And EPS again is equally up strongly, up to 20.1 cents. Balance sheet, again, we've touched on the cash position, just finishing marginally net cash. That's after 10.6 million cash consideration for the acquisitions. Also, obviously, the fact that on the earlier side we had the 2 million of acquisition and integration costs. Accrued MMTC, you would have seen at the full year we carried quite a significant balance in. I think at the time what we flagged to people was that there was quite a legacy issue of uncollected MMTCs within VMC, where we had claims going 2015, 16, and then the accruals for fiscal 17 in place. Again, getting back to the cash at year end, we should see the large proportion of those all harvested before the year end, which will assist greatly. CapEx, again, it's up at 3.8 million. Again, if you look at our numbers historically, we look at as a percentage of revenues that our CapEx should run at about 3%. Again, it's marginally higher here. in terms of what the traditional rate is. Most of that investment is coming in software and computer equipment, again, primarily focused around the testing, art and engineering service lines. And again, we've put extensive investment into some notable facilities. Montreal, which we've extended quite considerably. London, where we've put in a new sound studio. Dublin and Tokyo, which we continue to kind of grow organically. Net, there's been growth across the 7 service lines, and total seats created to the tune of about just under 700 new incremental seats in the business. Cash flow. Again, this is our low ebb at the half year. Reasonably strong cash conversion when you look at it as a percentage of KWS profit. Last year would have been about 30%. We're up to about 38% conversion. In the period, again, getting back to that previous MMTC balance of 14 million, 3.7 of it relates to this period. Again, that won't be collected and will be the accrued amount at year end. Dividend, again, back in line with the progressive policy of 10%. Just getting down to debtors days and WIP. WIP is up. Again, that's more a product of art and some of the engineering where there's a higher proportion of WIP in those service lines. And as our exposure grows to that, so does the WIP. Debtors days is marginally up. I suppose really a function of a very small handful of clients who fell the wrong side of the June-July divide. If we look at the July kind of conversion, we are back down to kind of 45 days. So nothing really particularly unusual in that. Overall guidance, again, it's in the release this morning. Strong organic and acquisitive growth is what we expect for the remainder of the year. Benefit from the late 2017 H1 18 capacity and infrastructure investments. Again, the incremental seats that we've created and the investment that we've made back into the business. Equally, the contribution from the first half acquisitions being there for the remainder of the second half of the year. I suppose an easier comparative in dollar terms, in terms of current prevailing rates at about 116.17 is comparable to what we had for the second half of last year. Interest expense, again, expect that to rise to the extent that we utilise the facility. Tax rate, again, probably if we're slightly down on the 19.3 that we've achieved at the half year, but broadly would expect it to remain the same. And again, the kind of cash conversion in the second half of the year is a trend that we expect to see and continue.
So, looking at some of the areas in a bit more detail. So as you know, Keywords is a sort of story of two halves. One of them is the organic growth, which we pride ourselves on delivering period after period. We've grown again organically, arguably perhaps not as strongly as some might have expected in the first half of the year. It is just one of those halves that's a little bit lighter in the first half compared to what we're expecting in the second half. On the other hand, we have performed very well in terms of our acquisitions, both in terms of the acquisitions we've made this year and the acquisitions that we've integrated that we bought in 2017. So in terms of the acquisitions, I won't list them all, they're on the sheet for you, but just picking out a few of them, starting from the back. Studio, Gobo and Electric Square, which came into us recently, performing very strong. Those guys are really on fire at the moment, and they're providing full game development services as a kind of work for hire arrangement for clients, as well as co-development services in much the same way that our Sperasoft business is doing already. Fire Without Smoke and Trailer Farm both bring the marketing services to Keywords for the first time. So we are now selling services to the marketing departments of game companies where we've not previously been present at all. And as I've already mentioned, Called and Laced take us into a whole new field of music services. And that has been complemented now with the, some would call it acqui-hire, of SoundLab that we announced this morning, which takes us into the realm of sound effects and sound design for both games and movie and TV content. So service line by service line, all service lines grew strongly. Admittedly, some of those were more affected by acquisition than organic growth. But the overall performance has been very encouraging. So I'm not going to labour all of these. Suffice to say that our art creation business is started the year a little bit light, particularly the first quarter, but things have picked up very strongly in the second half of the year. And obviously it benefited from the acquisition of Fire Without Smoke. In our audio services business, as David has previously said, some of the bigger projects that we traditionally do for the voiceover, particularly the foreign language voiceover of major games, have fallen into the second half this year as opposed to the first half last year. So that has a bit of a second half weighting and weighed on the organic performance of the audio business in the first half. But it's benefited from quite a lot of acquisition activity with Chord, Laced and Blind Light all coming in addition to Maximal, which was at the beginning of the year. Our localization business, very, very small impact from VMC, but also impacted from the full contributions of the French acquisitions that we did in 2017. And so that business is up 13% year on year, and we've also worked hard to improve the XLOC platform and have launched XLOC 6.0 during the year as well. In our localization testing business, revenues are up 10%, largely thanks to the integration of the VMC business. And if we move on to functional testing business, this was heavily impacted in a positive way by the integration of VMC, and the team there has done great work in fully integrating the VMC business into the existing Keywords operations and vice versa. And we've expanded our offering with the global beta test network that we acquired through the acquisition of VMC as well. We're now, just so that you can get a sense of how we work things in using the studios that we have for various service lines, we're now doing a little bit of functional testing in Volgograd, which is a location we acquired through Sperasoft. So that's a fairly low cost but high capability location in Russia. Player support business, very much a highlight of this first half. It's grown very strongly, both organically and in total, again thanks to the acquisition of VMC, which came with a fairly good-sized player support or customer support business. And again, this is a business which year on year is very quick to install itself in different locations that Keywords has around the world. It really demonstrates, perhaps more than the other service lines, the power of being able to use that geographic footprint that Keywords has created. And it's continued its expansion apace, both in Poland, where we acquired some presence through the acquisition of Sperasoft, and also in Manila, which was through a business that we acquired from a client a couple of years ago. And then the final one to talk about really is engineering. So it doesn't make sense to talk about percentage growth in engineering because it was so small in the comparative period. But as you'll see, we've continued to invest in that engineering business with the likes of Snowed In and Studio Gobo and Electric Square coming in. It's a business which is very much in demand. There's definitely a strong move towards outsourcing of engineering and development services. Some clients are outsourcing full games for development. Others are now adopting a more distributed way of making games. So using co-development partners around the world. And I think Keywords is very well positioned to benefit from that trend. So going on to midterm organic growth opportunities. So I think we need to stand back and have a little think about what's going on in the games market at the moment. And I've certainly come back from a couple of conferences recently, E3 and XDS, recently, with the strong sort of noise from the industry about streaming. So streaming of video games has long been talked about. There's definitely a sense in the industry that this is something that's perhaps a bit nearer term than people were expecting. There are some fairly serious players getting into the space for video game streaming. And I think with broadband bandwidth increasing for many people around the world, plus the advent of 5G mobile networks, we're going to see that combined with improvements in technology to deal with issues of latency and so on. I'm pretty sure we're on the verge of seeing some interesting developments in game streaming. And I think for Keywords, that's particularly exciting because there's, well, I imagine there's going to, no one's seen it before yet, so I imagine that there's going to be a bit of a rush and a bit of a fight for content amongst various platform holders of streaming, of game streaming content. If you imagine the sort of thing that we've seen with Netflix, I can only imagine something similar will happen with games, where there's, you know, you have to fill your platform with content in order to justify your subscription price and to attract new players to those platforms. Also of interest are the rumors about new platforms, new consoles, so perhaps a new Xbox and a new PlayStation. Those devices were last launched, the last generation was launched in 2013. So perhaps we're due for a refresh, and I think people are expecting something in the next couple of years from both of those platforms. So I think that will be good for Keywords as well. I think one of the things with games being a service now is that a lot of the games that are out there in the marketplace are running on a sort of constant basis on the existing platforms. I can't imagine those games being cut off from one day to the next and move to a new platform. So I'm assuming that our clients will need some help to either manage the existing content or to help them develop new content for the new consoles. We also continue to expand our services. We're certainly going to be building upon our development services going forward, so you should expect further acquisitions from us in that space. But we're also recruiting aggressively across all of our locations. You know, we simply don't have the capacity for all the demand that we're seeing. Our initial foray into the world of artificial intelligence with the acquisition of Yokozuna Data looks very interesting, very encouraging. We've got a lot of interest from our clients around the world. And I think, you know, we'll look at other areas for the use of AI, either through the team that we have in Yokozuna Data itself, or indeed through other potential acquisitions. And as mentioned in the bottom bullet point on that section, our establishment of Keywords Ventures, I think again that's a perfect vehicle with which to look at potential investments in some advanced technologies as well, which we can bring to the games industry. And then finally, our increasing market share. So primarily, of course, the cross-selling opportunities that we have, and we've demonstrated year on year our ability to achieve those cross-sales. We'll be continuing to do that. We still look forward to the possibility of spin-outs from clients as they decide to focus in on what's really important to them as a games publisher, or a game developer. And as a pure play service provider, we hope that they will think of us as being a partner that can undertake some of those activities for them as well as they currently do them, if not better. So looking forward to that arriving. Also, we're seeing strong interest and demand for companies that can operate games in live operations for our clients. So this is not the high level sort of creating a game, but once a game is created and is launched, there's a whole long tail now because of games as a service to keep those games fed with content, to provide the player support, the ongoing testing requirements and so on. And there are definitely some of our clients in the market that would like to find homes for those games of theirs on a purely outsourced basis. So we're going to be looking at ways in which we can assist with that. Acqui-hires, as we've demonstrated with the hiring of a full team from Sound Lab in Hollywood just recently announced this morning, we'll be looking for other opportunities like that. And there are certainly some, what we're seeing with Keywords is it's becoming an increasingly attractive place for people to work. And those people that might find themselves in a home where they don't feel particularly comfortable, we hope that Keywords can provide them with a more exciting and dynamic environment so that they can do the best possible work that they can. And then for our acquisition strategy, people sort of ask, are you going to be continuing to make acquisitions? Absolutely, that's what part of the whole Keywords story. So we've made 8 so far this year. There are still a few months left of the year. I'm not going to promise anything, but there could well be another acquisition or 2 this side of the year end. And into next year, of course, we'll be continuing our acquisition strategy. So as I've said before, acquisitions in engineering. We've taken a bit of a break on the art front for the last year or so. As that business has integrated itself more fully, next year might be an opportunity for us to look at making some more art acquisitions. We don't want to overburden a single service line or a single geography with acquisitions, but I'm hoping that next year we might see a bit more activity there. Also, our audio business will continue to benefit from investment in acquisitions as it has done this year and last. And then finally, in terms of the geographic expansion, as I've already said, I think Eastern Europe, we entered that space with acquisitions in Russia and Poland. Again, we like what we've seen. We'll be looking more closely at that region for some of our existing services. And before anybody asks the question of how do we manage all of these studios around the world and do the acquisitions and all the integration that we do, the answer lies, at least in part, on this chart, but perhaps more importantly, it lies in the hearts and minds and dedication and hard work of some 5,000 Keywordians around the world, all of whom are doing their very best for the projects that they're assigned to. So we've made some changes in the management organization during the period. Most notably, we've appointed Igor Efremov, who joined us through the acquisition of Sperasoft. We've appointed him to the role of Chief Commercial Officer. So he is very much frontline, in front of clients, flying around the world, spending time with the service lines and studios, and really leading their growth ambitions from the front. And we have integrated the sales and marketing team within that service line team. So previously it was separated. For those that can remember the chart, that function used to report to me while the service lines reported to Giacomo Durante, our Chief Operating Officer. So we've shuffled things around a little bit. We've also appointed a Chief Marketing Officer in Andrew Brown, who comes from Activision Blizzard. And we've also integrated Mark Rizzo, who again came to us through Sperasoft. So he's going to be working very closely with Giacomo in managing all of the operations on a sort of regional facilities basis, IT, HR, and so on. So again, a strengthened management team going into 2018 and beyond. And gives me more time to get up to mischief as well. So perhaps focus a little bit more on strategy and acquisitions. So, outlook. As we've already said, the trading in the first few months of this year has been very much in line with expectations. It is quite a hill to climb in the second half. We know that. I think to get to expectations, our organic like-for-like growth needs to be 15-17% for the year, which is quite demanding, but we look forward to meeting those expectations. And I think to help us with that, the previous investments that we've made in facilities and in people, the headcounts that we've added, will help us achieve those results. So continued organic growth and perhaps accelerated organic growth into the second half is what you should expect. And also getting the full year effects of the acquisitions that we've made so far and driving out those operational synergies. Obviously, we've already done a lot of that work at VMC, so don't expect a huge amount more in the second half, but there will be a little bit more to come. And the sort of final point to mention is, of course, we do maintain a healthy pipeline of acquisitions. And we now have 2 full-time corporate development managers, which we never had before. So that's perhaps an indication of how strong that pipeline is. And those guys will be working with me to make sure that pipeline remains healthy and that we execute on those transactions in a timely fashion. I should also say that I forgot to mention earlier on that management chart, not only have we made investments in senior management, but also at the mid-management level as well, with the appointment of a group treasurer, group tax person. We now have a director of finance and so on board. So as we're growing as a group, we're not shying away from making the investments to support the business as it is today, but also for the future. Despite obviously the fact that those investments weigh a little bit on our operating margins as well. So final slide to leave you with. Nothing much has changed on this one, the investment summary. Keywords remains very much the same company. We provide investors with access to a large high growth market, and in a way that sort of evens out some of the otherwise volatile effects of games that are either massive successes or not. And I think that's kind of aptly illustrated with the story I was painting around the Fortnite effect earlier. I'm going to leave it there and see whether anybody's got any questions for myself or David.
Just on the first point, you noticed that Fortnite was maybe a bit of a headwind in the first half, maybe a bit of a tailwind in the second. Just as to why that's changed over. Yeah. So in the first half, we weren't doing a hell of a lot on Fortnite in the first place. Fortnite came as a real surprise hit to us, and who knows, maybe even to Epic Games, the developer and publisher of that game. And I think as its success grew, so the company needed further support on the game. So we were a fortunate beneficiary of that. The other thing that I'm reading into the situation is that perhaps some of our clients have already felt the effect of Fortnite, so that negative sort of the negative impact that it's had on their games might have sort of tailed off into the second half. So I'm hoping that they've hit the bottom and we'll find a way up from there. And then just something that a lot of the gaming companies, both local and international, have been speaking about is that H2
more so actually Q4 is probably the most congested sort of release schedule for many years. What's sort of your view on that, and is that part of what gives you sort of the confidence going to H2 with the added capacity as well?
Yeah, there's a bit of that. So there are a bunch of very high-profile titles all coming to the market at the same time, and I think there's been a little bit of jostling for launch positions as well. I wouldn't be surprised if we don't see some slippage of games into the first quarter next year. That's not abnormal to see, of course, but here we've got games that are, they've got release dates set already for the 22nd of November, which is very, very late, obviously. It's only a couple of days before Thanksgiving. So, but yeah, I mean, that's part of what you see in our trading pattern with a stronger, slightly stronger than normal second half. It might well be because of all those big games launching at the same time. A lot of the work that we're doing, particularly in audio, in localization testing and so on, for those games happens in this second half because of when they're releasing.
Hi, Jerry. Good buddies. You mentioned and commented in the statement about the synergies you're getting from VMC. Can you quantify that or give us data points to support that?
Yeah. So basically, what we've done at VMC is we have combined, I think, 5 facilities into 3 so far. In fact, we've combined 2 Keywords facilities into 1 VMC facility in one location. We've also reduced the management team combined between VMC and Keywords, but with most of that coming at VMC. And we've integrated VMC into our tools and processes and our finance and HR and recruiting methodologies and so on. So it's fully integrated, and with that comes quite a lot of cost saving. So we've stripped out a pretty large chunk of the cost that we were expecting to strip out over a 2-year period. We've already stripped out a big percentage of that. So we're well ahead of our integration plan in that respect. What remains to be done now is for us to get that top line at VMC to grow.
Hi. You mentioned earlier the effect of Fortnite, but going forwards, we have a number of large publishers who are trying to mimic success in the Battle Royale genre. Mm-hmm. What kind of effects are you seeing going forward? Are we expecting something similar to the impact of Fortnite, or will not everybody be able to replicate that kind of success?
I wish I knew. If I knew, I might be a publisher rather than a service provider. I think it's a very, very difficult call to know how to deal with the success of Fortnite. On the one hand, it's definitely got people interested in games and playing games that weren't playing games before, so it has a very positive effect in that way. But going head-to-head with Fortnite is a difficult prospect. Certainly Battle Royale as a game mode is being introduced into a lot of games now, so it'll be interesting to see whether the success of Fortnite and indeed PUBG, which we mustn't forget about, whether the success is down to the mode itself, or is it's wider than that. If it's down to just a very enjoyable game with all the right art style and the community around it and so on and so forth. I mean, I keep seeing people doing the dances from Fortnite, the floss dance and so on. Don't ask me to do it. But yeah, it really is a phenomenon.
And just to follow up on that, the variations in genres, does that represent more opportunity for Keywords going forward, or are we seeing some of the other genres disappear?
No, I think, I mean, we're very agnostic to platform, to genre, to anything. So, we work on children's games, educational games, serious, simulation games, and all types of games on all platforms. So clearly, what happens in a market like this is people start to differentiate their games one from another. Some of that is by appealing to different demographics. Some of it's with different features in their games that appeal to particular players. So, you know, there's obviously a group of players out there that likes to play first-person shooters and people that like to play racing games and so on. So, you know, if you've got a racing game, you need to make it different from other racing games, but still appeal to what people like in a fundamental racing game. So I think different genres are something that Keywords has been living with forever, and I would think that over time those different types of games just keep broadening themselves out as gamers. You know, they you look at the average profile of a gamer, it's been transitioning from sort of 18 years old and younger type people to middle-aged, more women gamers than ever before. And I think, you know, as that market broadens, so the types of games that appeal to various segments within that market will change as well.
Two questions. It's on, yes. Two questions, kind of related. First question, if I'm a developer in Brighton and I get acquired by Keywords, what happens to me to make me feel excited about being at Keywords versus going off around the corner and working with some other guys with green hair, which is what they like to do? How do I feel part of the organisation, and how does that all kind of play out? And the second question, if I'm a client of that place in Brighton that then becomes, I guess, accidentally a client of yours, what happens to me? Do lots of people start calling up, telling me about the marvellous things that Keywords can now offer me, or how does that whole kind of process work?
That's a good question. Yeah, I mean, I think when you become part of Keywords, the first thing you should feel is that you're part of a bigger family with a bigger support network. So more HR capability, more job opportunities around the Keywords group. You also will feel as a business support from sales and marketing who'll be driving more opportunities to your door. You might not be able to execute on all of those opportunities, but you should feel more secure within the Keywords family, knowing that these your world of opportunity has got suddenly much larger. The other benefit you'll experience with Keywords, as opposed to going to the people with green hair or whatever that you mentioned, I think is that you can still stand out from the crowd. So you're not absorbed in a big development studio and you're just another developer or group of developers that could otherwise have been hired through the market. So you maintain your brand, you maintain your a degree of your identity, but you're very much under the Keywords umbrella. So it's a delicate balance for us to get. There's the back-end integration. Of course, the other thing that happens is suddenly now you're having to report some fairly sort of hefty reporting packs on a monthly basis. There's probably a little bit more discipline and rigor around IT, finance, HR, and so on. But hopefully the benefits well outweigh that. So that's the first thing. The second part of the question was what it feels like to be a client. So I think increasingly clients are comfortable with Keywords acquiring businesses where they're already working because they've seen us do it so many times before now, and they're not negatively impacted in any way. So understanding that Keywords is there to provide services to them as a client base is increasingly sort of understood, and we're not taking resource off the market. In fact, we're securing that resource for the market. So by and large, clients are very relaxed about Keywords making one of these acquisitions. To your point, do you suddenly start getting Keywords people phoning you up and trying to sell you music services or something?
It's not quite like that. But obviously, if there's a client that Keywords doesn't already work with, we may well be talking to the studio in Brighton that we've just acquired and say, hey guys, can you make us an introduction here? Because we have all this other great stuff we would like to tell your client about, because they might be interested in using some of it.
I think it's me next. You mentioned the idea of outsourcing from clients, which you have talked about before. Is there anything that makes you think that that is actually any nearer than it was 1, 2, 3, 4, and 5 years ago? And also, could you talk about what sort of scale you think that might happen at in terms of individual contracts, if you were to see that sort of thing?
I can probably better answer the second part. I think the scale of these potential spin-outs could be anywhere between $10 and $40 million a piece. You know, a lot of the services that we currently provide are still being provided internally at some of the larger publishers around the world. So if those do happen, then they could be quite big chunks. Is there anything that makes me think that they might happen? Certainly what's happened over the last sort of year or two is that certainly myself, I'm starting to have more dialogue with more senior people at our clients than ever before. So I'm talking to CEOs and so on, and they see the logic of focusing on, let's say, the more pure publishing side of the business without necessarily being weighed down by the operational burden of running their own testing departments or player support departments or whatever it is. Whether they get comfortable enough to make that transition, you know, in the next months or whatever, I'm not sure. But I've been talking about this for a while, so I don't want to make any sort of promises or set any expectations. But honestly, I'm a bit surprised we haven't seen more of that already.
Just a quick question from me on organic growth, really, and also bringing in VMC into it. Can you talk a bit about, and sorry if I missed this earlier, but about why VMC wasn't growing before? Because it's, you know, where I'm coming from, it's quite a challenge to cut costs in a business and then turn it around at the same time.
Yeah.
And, you know, what is the timing there in terms of returning that business to growth? Because if it doesn't happen in the second half, when you've obviously got quite a challenge ahead of you in going from sort of 9% growth to what will need to be sort of 20% growth in the second half. So, you know, if that's a drag, that'll make that more of a challenge. And the other sort of part of the question is around the gross margin, which you said was better because of mix. The other thing that can help gross margin sometimes is pricing. And given the demand environment, I just wondered if, and that could also help the organic growth if you get some pricing improvements as well. And the final part of it is just that organic growth figure that you helpfully give us. Is that an audited figure, or is that something that you just have to do yourself?
That's unaudited at the half year.
But it will have been reviewed by our auditors. So it is reviewed, part of that dialogue.
And then fully audited at the full year.
Correct, yes.
Thank you.
So in terms of VMC and why it wasn't growing in the past, I think partly we were winning business from VMC as part of the answer. The other answer is that it had been through some changes in management. So it went through a period about 3 years before we bought it of perhaps an underperforming management team that was changed by the corporate parent, which is a publicly quoted company. It then ran for about a year without any senior management team in place. They put in place a brand new management team about a year before we acquired the business, and that management team hadn't had an opportunity to positively impact the performance of the business. And in our view, their strategy was, well, it wasn't compatible with where we would have taken the business anyway. So the answer is perhaps it's down to management of the business rather than anything else. It's certainly not down to the people doing the work. People doing the work are just like Keywordians anywhere. They're very passionate about the projects that they're entrusted with. But, I think there's quite a heavy management layer, and, a lot of the cost reduction we've seen has come through a reduction in that layer of management. How do we then get it to grow? I think the answer is, in places like the US and elsewhere, and Canada, where for some of the services we are, through the acquisition of VMC, very much the go-to provider of these services. So I think we'll see a natural tendency for people to call us and to invite us to provide services to them. I think, as well, it's down to focusing on the day job and not go off pursuing strategies outside of the games industry, which is what that company was doing. And it's also about getting clients settled. So we acquired VMC. There were some large clients that were very unsettled and probably would have left VMC had we not made the changes we made. And part of that's down to culture, part of it's down to how you engage with clients, whether you're listening, whether you make the changes that clients are asking. And Keywords is very good at that. We're very adaptive, and we've brought some of that behavior to VMC. As a result, clients are increasingly comfortable with working with VMC. So I think we will get it to grow, and I'm sure that the market demand is there to enable us to do it as well.
Hi there. I was just trying to get a sense as to a sense of your overall ambition here. How large can Keywords grow, or should Keywords grow? 50 studios, 5,000 people at the moment. How much further is there to go? And is M&A? When does the M&A slow down?
Yeah, I think the answer is Keywords has a lot of runway ahead. I mean, it's a very large market. It is a bit of a niche market. It's quite difficult to get into this market from outside. We are the leading consolidator in the services side of the games market, but there's a lot of consolidation still to be done. So I think the acquisitions are going to be continuing for the foreseeable future. Having said that, we can get to points, almost like a tipping point, where you've made enough acquisitions in a particular area to become this go-to provider, in which case the incremental impact of acquisitions is kind of reduced, and we'll have to think whether we want to continue making them just because they're there to be made. How large can we get? Well, we're operating in a $6 billion market. There is a trend towards outsourcing, so we should naturally benefit from that. The industry itself is growing. We have a small market share of 5% or something. So, why not be $1 billion in 5-7 years time? I don't know.
But at the moment, the main competition are essentially the in-house resources of the publishers. There aren't many other competitive third-party consolidators?
Well, half the market is already outsourced, but it's a very, very fragmented picture. So there are hundreds of small companies out there providing good services, but at limited scale and usually on a single service basis and single geography basis. So. And then, as you rightly say, in a way, the biggest competition is internal, or let's say the biggest opportunity is a move from internal to external.
Two more questions. What percentage of your revenues would you describe as recurring, not in an accountancy sort of sense, but just in terms of same client, different game kind of thing? And second question related to the big release schedule in H2 of this year. By the same token, does that not lead to some kind of industry lull going into 2019, putting aside Cyberpunk, I guess? Is there, and what are your thoughts on kind of how 19 looks at the moment vis-a-vis 18?
The second question about the concentration of major titles coming out in this gifting period that we're heading up to. I think on an individual basis, there's, you can look at it and say there's a bit of saturation coming there, but not all of these titles are competing with each other. They actually appeal to different players. But there's obviously a lot of noise in the market. So if you're thinking about marketing a game, even if the games aren't directly competing with each other for players, they're competing with each other for marketing slots, as it were. So I don't necessarily think it means that you end up with a sort of saturation point that then means that you go through a dry period into Q1 19 or anything. In fact, I think Q1 19, Q1s, what you tend to find is that pretty much all of our game clients have year ends of the end of March. And so if there's any slippage in their slate and they don't see an opportunity to market a game in the lead up to Thanksgiving and Christmas, they'll market it in Q1. And arguably, the people that have bought the games pre-Christmas have been playing them all over Christmas, so they're ready for something new, or at least to see the latest iteration of one of the games that they're used to playing. Sorry, I forgot your first question. I apologise. Oh yes, recurring revenues. That's a good point. So the way we put it, the way I put it, is that every year when we sit down to do our budgets for the following year, so we're about to start the exercise for 2019 soon, what I expect to see is that 80% of our revenues for 2019 are coming from our existing clients that are buying the existing services. So I don't know what that makes our recurring revenue rate, higher than 80%, but less than 90%, I would say, something like that. It's a surprisingly sticky business.
Morning. Just on your CapEx spend, is quite a hike versus last year. Is that a step up that we can see as more of a permanent step up, or is it one-off in this half?
I think it's a little bit one-off, but I think our CapEx rate as a whole might go up a little bit from historic levels. I mean, we have some major investments to make in France going forward for the next year or so. And I think, as we see this demand coming through, we will be happily investing behind the demand. So, if that means we need to make more space available for more workstations or whatever, we'll be doing it. As technology advances, if we need more test equipment, more computer equipment, just as we're used to doing, we don't hesitate in making those investments. So I don't think it's a fundamental shift in the capital intensity of the business or anything. It remains low capital intense, but I'd be delighted to invest to support the demand.
Just looking at your revenue visibility for the rest of the year, given the 4.5 months to go, what sort of visibility do you have over the revenues that you need to achieve for the rest of the year, and what are the key things that need to happen for you to meet the number, beat the number?
Yeah, so at this time of year we have, I would say, good visibility of what's out there. So, in our numbers, there's very little sort of unnamed revenue opportunity there. So everything's, allocated to a project or to a client or whatever. That's not to say that we have complete certainty by any means. It would be nice if we did, but there's always room for project cancellations, project delays, unexpected projects coming to us, and so on. So I think we have good revenue visibility, which leads us to be, confident in the outturn. But there are always, uncertainties as well.
And then just on the acquisition environment, are you seeing any change in the competitive environment for acquisitions? And if you are, does that vary by sector?
Not really. I mean, we know, for instance, that there are companies that have expressed an interest in acquiring game development and art studios. I haven't seen much activity on that front yet. Sumo Digital bought a small business in Brighton recently. I'm not seeing a huge amount of competition, but
if it happens, it happens. I think I'm not going to worry too much about that. I firmly believe that Keywords is a very good home for these businesses, and they'll think about that very, very carefully if there is competition for one of those assets.
Hi, thinking that David's getting too easy a time here, not having any questions addressed to him. But either of you are welcome to answer 2 questions. One, in a way, a different slant on the CapEx point. To me, 5,000 a piece for 700 seats doesn't sound like a hell of a lot of money. That doesn't buy you the fanciest bit of kit on the desk. And related to that, a more general point, and it may not be the biggest thing, but it seems to me that you, and maybe it's just a few acquisitions, but there's a number of small businesses you've bought, which, you've paid a price, which includes intangibles and goodwill, and you've then gone and spent some money to kind of kit them out in a way perhaps that as relatively small organizations, they were a bit underinvested, which I guess ends up on your balance sheet as PPE and being depreciated. Then you pay some contingent or some earn-out, which I guess all gets attributed to goodwill. So that, not enormously, but that seems in a sense to be somewhat penalising you in the sense of you get the depreciation and the PPE cost, and everything you pay gets credited to the, or largely to the goodwill.
If you look at a lot of the, let's say the expansion that we have, the large proportion of it is into, let's say, bigger, more organic facilities like Montreal. There is the specific spend around liquid violet in London for the setup of a studio there. You're right about, it isn't a particularly CapEx intensive business in terms of what it needs and ultimately what it requires. When you break it out across the average number of seats, it is the basic kit for the testers. There are maybe some specifics around, art or engineering and what they need. But it's not that particularly intensive or kind of high end. So, when you break it back across that basis, I think if you did the same across our historic numbers and the seats we've generated and the service lines that, traditionally, and again, the narrative historically has been similar. It's been around art, it's been engineering is just over 12 months old, but, testing, again, is one where we seek the seats and that. So that the areas that get it, the number of seats that are generated, the nature of the service are all generally comparable. You'll probably end up with a similar breakdown on a per head basis, so that there's nothing new per se within that. So that's let's say the run rate on that part. Going back to the other part of the question, so your position is that we're being penalised for.
Well, it depends. I suppose you could say you exclude amortization of intangibles and whatnot. But I'm just saying, is it a general feature that you tend to buy businesses that are somewhat underinvested and you wind up spending a bit of money on? I'm not suggesting this isn't necessarily good, bad, or that significant, but it seems a little bit like a feature. And maybe that's just because I just read the Broderick Sound Lab thing and 1 or 2 others, and they seem to fit that pattern.
Yeah, I think the investment would typically follow after earn-out rather than during earn-out for anybody that's on an earn-out. In the case of Sound Lab, it's it's instead of making an acquisition, we hired a bunch of guys, but then we've then got to go and get out of place. So that's a little bit different. But yeah, to your point about spending money, investing money in companies that join the group, yeah, we're very willing to do that, particularly if they're performing well. So you can see it around the group that perhaps not all of them, of course, come in on earnouts, so maybe some of that spend goes in earlier than otherwise, but it's part of the deal of joining Keywords. We want these companies to grow, and if part of getting them to grow is to invest in them, give them better facilities, give them better equipment, increase capabilities, staff, and so on, we're very willing to do that. And we don't really think about, well, the fact that we paid, X million for them 2 years ago means that we shouldn't invest any more in them now.
Fair enough. And the second point is just on currency. You made a few general comments, but could you expand on the sort of mix, your ability to kind of match currencies to costs, or where you're not matching them, how do you then hedge or deal with that?
Well, we don't enter into any kind of hedging instruments at the moment. Our biggest overhang is dollar revenues over dollar costs. Again, our principle, if we take our cost basket, I mean, it's again where our major centres are. It's Canadian, it's Euro, it's USD, and it's Yen, with a bit of Renminbi and Rupee thrown in for good kind of measure. Canadian, Euro, USD are the predominant sides of the cost base. Again, from revenue perspective, we have a reasonably equal or manageable match across from revenues to costs. The excess is on the dollar side of revenues over a dollar cost base, and that's where the principal kind of exposure would rest on that.
And you're happy not to sort of go out when you win some business in dollars that you're going to carry out in euros, or?
Again, it gets back to the essence of the business of being, in the main, being a time and materials business. And back to Andrew's point, we can have clients shift like that. But I mean, again, just Andrew flagged it there. We have brought in a treasurer. He is looking at all our kind of matrices that were across the organisation. Our currency is what we're holding, the most efficient way, and there is a discussion about all of those opportunities. If we went into engineering, we had longer term projects. There's a degree of certainty over cost overhead, milestones, payments. To what extent you may or may not hedge and secure some of the margin on those.
Thanks.
Just a quick one, just to follow up on the second half kind of skew. Can you just give us some colour on what service lines you think are going to help support the growth? Just a bit of colour.
I think I might have already mentioned that art got off to a bit of a slow start, so that's got a far more robust trading picture in the second half. Player support remains very strong growth. Localization has suffered quite a bit from the fortnight type effect, and certainly a major client of its has been badly affected in the first year. We're expecting that to in the first half. We're expecting that to stabilize in the second half. The engineering business, I'm expecting to perform strongly. There are some pieces of uncertainty in the engineering business. We're transitioning from some major projects in Sperasoft in particular right now, so it depends on how quickly that ramp down happens on the existing projects and the ramp up on the next projects. But the overall picture is extremely positive. Got some very, very high high-end, high visibility projects coming into Sperasoft. So no, I think it's going to be sort of strong across the board. Functional testing remains strong as well in the second half. So I'm expecting a good performance across all those businesses. And as I indicated, audio is benefiting from a stronger second half already. So I think we might have exhausted all the questions finally. So thanks very much, and I'm glad you all were listening.